Welcome to the Lend Academy podcast, session number 13. Today on the podcast, we are welcoming Don Davis. He is the managing partner of the Prime Meridian Income Fund. And that is a fund that invests in peer-to-peer loans primarily on the Prosper platform today. So I first met Don at a meetup in San Francisco last year. I was quite impressed with what he'd been doing and wanted to get him on the podcast to give the listeners a bit of a different perspective here. We are going to learn about the challenges that institutional investors face when trying to put their money to work on these platforms. We're going to find out some of the details about his fund, a little bit about his strategy, where he is putting his money today and where he expects to in the future. And we're also going to talk a little bit about the industry and where he thinks it's going. So I hope you enjoy the podcast. Okay, welcome to the podcast, Don.
Yeah, thank you. Glad to be here.
Okay, so why don't you just start off with giving the listeners a little bit of background about yourself?
Sure. So I've been involved in the finance and investment management business in one form or another for the past 20 years. In about 2000, at the turn of the third millennium there, I was a consultant to the finance industry. And I was one of those, at the time we were very good at identifying trends, macroeconomics, and technical analysis, analytics, which has always been a strength of mine. I was one of those weird guys in 2000 that saw the writing on the wall and was giving advice to financial firms, clearing firms, broker-dealers, that we would enter a long-term secular bear market in equities over a 15, 20-year period where we would have a declining price-to-earnings ratios and kind of a flat to stagnant market in equities. And so it was my recommendation to beef up their alternative divisions and focus more on alternative investments. And so that eventually led to the creation of Novus Investments, which is an alternative investment management firm, and later Prime Meridian Capital Management in the peer-to-peer lending space.
Okay, so that was a pretty gutsy call back in 2000 because there was people just thought the party was going to go on forever. I remember back then. So
nobody listened.
Yeah, I'm sure. So then, so obviously you focus on alternative investments. When did peer-to-peer lending come across? When did it hit your radar?
Yeah, good question. So we were researching alternative income for some time and didn't like a lot of the products that were out there. The intrinsic risk, in our opinion, was much higher than the stated income. And we liked lending a lot. Lending strategies, we were familiar with the analytics. We liked the risk-reward ratio. We even considered at one time starting our own online payday cash advance entity at one point, and we would have funds that fed into that. We eventually heard about peer-to-peer lending about 3 years ago, Lending Club and Prosper. At the same time, an old friend of mine took a job at Prosper. And so we researched the space extensively. We sat down with Renault and company at Lending Club and the prior management at Prosper, and was very excited about what was going on in the space. And I even remember at one point offering both companies $250K in exchange for equity, from my personal account, and an offer to start a fund to become an institutional lender. Both firms laughed out loud at the equity offer.
Bummer. It would have been good if they'd taken you up on it.
It would have been very good for me.
Yes, exactly.
But they advise that they only work with the big boys, the VCs and the major institutions and so forth. But we started the fund nonetheless, and that was in early 2012.
Okay, so then can you just tell us a little bit about your fund? This is the Prime Meridian Income Fund, I presume you're talking about. Can you just tell us how it's, like, what you invest in?
Yeah, so we invest in both whole and fractional loans. We do it through an institutional API, so we invest in all credit grades. It's a broad-based, diversified portfolio. We buy our fair share of AA's and A's, the super prime. We underweight some of the lower quality loans or reject some of the lower quality loans as well. But overall, we currently have a diversified portfolio of over 11,000 loans. It's very broadly diversified. If anything, it's tilted towards the higher quality side of the equation. versus the lower quality. And our goal is to manage the best risk-adjusted loans that money can buy, through various stages of the economic cycles.
Okay. So then you've got 11,000 loans. So it's not all whole loans, obviously.
Correct.
Okay. So, and is it primarily on Prosper or Lending Club or a mixture of both?
Yeah, we started off with Prosper. Prosper has been our primary and exclusive provider of loans since inception, and they've done a great job working with us. The service has been great, especially with the new management team, the Vermoots and Suber and company that came in last year, and everything's been great there. All along, we had long-term plans of working with Lending Club. It was just Prosper in the early stages. We just started there for one reason or another. We are looking to begin working with Lending Club in the very near future, and we're also looking at begin working with Funding Circle as well.
Okay. So So right now, it's obviously, if it's just Prosper, you're only in consumer loans, and you said you go all the way across the spectrum from the AA's down to the HRs. Is that what you do?
Correct, except we have very, very little HRs.
Okay, fair enough.
About 2%. 2% of the portfolio is HRs. So, but yeah, we're investing across the spectrum.
Okay. So then, who are the typical investors who come to you and want to invest in this fund?
Family offices, high net worth individuals. We're getting a lot of interest from investment advisors, especially advisors that have their own funds out there. That's a very good match for us. And at Novus, our affiliate, we've been working with advisors for many years, so we have a lot of experience in servicing advisors, knowing what advisors want, taking care of some of the reconciliations and things like that they look for when they partner with someone. So fund of funds, advisors, we're starting to talk to a lot of bigger institutions now as well. We're even talking to a couple of regional banks and credit unions.
Interesting.
We're talking to a couple multi-family offices, and so it's just talk, but some of these larger institutions are very, very interested. After talking with us, they understand we definitely know what we're doing. We know the space very well, and they know that there's as you know, that there's constraints, and if they want access to the space, sometimes that involves maybe them going through a few different funds to get that access.
Right. Yep, for sure. Okay, so then what is your minimum investment?
It's currently $250K, but it's increasing to $500K after May 1st.
Okay. So and is the structure a 3C1 fund, or how have you structured it?
Yeah, it's a Reg D 3C1 fund limited to accredited investors.
Okay. And then, so this is obviously the Prime Meridian Income Fund is just a part of what you do. You're still sort of maintaining your Novus Investments role. Is that correct?
Yeah, Prime Meridian was the outgrowth of our experience and success at Novus Investments. So it's managed. It's an affiliate of Novus, but it's managed by the same staff, same management. So in-house, it's sort of like a separate division of Novus Investments. And it really does tie in neatly to what we do at Novus, because Novus is an alternative investment management firm. Right. So that's what we do. We do alternative asset allocation. So a lot of times, we're talking to a family, for example, and they want to allocate a portion of their portfolio outside of maybe buy and hold equities or fixed income or bonds. So it really does. It ties in very well during those discussions. Obviously, peer-to-peer lending, and Prime Meridian Income Fund is a big part of a alternative fixed income, component, and then we can talk about other stuff that they may have an interest in as well. Right.
So your clients might come along. You get a large family office, and they might say, well, what else do you have? So you can then point them to, well, we'll take a big chunk and put it in peer-to-peer lending, but we've also got other alternatives for them as well.
Exactly.
Okay.
Right.
Got it.
Yep.
So then what's the strategy for your fund? I mean, how do you pitch this to investors? Is it just, like alternative fixed income? What is the strategy there?
Well, it depends on the context of the conversation. It's not kind of a flat canned, pitch when we're talking, but there's a lot of, informed investors out there, especially in the families and high net worth individuals that are becoming aware of peer-to-peer lending. So certainly we like to figure out exactly what they, what knowledge they do have. Are they familiar with peer-to-peer lending? Have they heard of Prosper? Have they heard of Lending Club? And so on and so forth. But depending on what they already know or don't know, we go into detail from there. But we look at this as an excellent alternative to the fixed income portion of their portfolio, not necessarily to replace it entirely, and that depends on the objectives and the overall size of someone's portfolio, but definitely a very healthy alternative to the fixed income portion of the portfolio.
Right. So you don't advise them to sort of sell all their bonds, or you just say this is something that that can be a complement.
Exactly, and we've always shied away from that, Peter, over the years, about telling someone what not to do, because we're not so arrogant to think we know exactly what the future looks like. So we never tell someone to sell all their stocks, sell all their bonds, but what we do say is more in the affirmative, is that we strongly recommend that you consider allocating some to this. What you sell or don't sell is really up to the investor, but to find a way to put this asset class in their portfolio.
Right. Yeah. So so you talked a little bit about about the constraints today. We all know, everyone who follows this industry knows how popular this is with investors these days, and the constraints that brings. Are you growing as fast as you like, or are you constrained as well?
Yeah, that's the question. I mean, we're seeing steady, measured growth. It's very important to be able to scale in this business while at the same time being able to have very efficient utilization of cash. So we're working it out. I mean, it's about communicating with our providers like Prosper and making sure we have the capacity based on how much deposits and assets are coming in, and sometimes that means going to investors that are looking to allocate larger amounts and having them phase in over several months. Right. Which is part of the business, and they don't seem to mind. They understand. I mean, if you want to allocate a large amount at one time, let's just phase it in over a few months, and then once you're in, you're in. You're neatly invested. But why should we take all of your money now just so we can charge a management fee? And if we can't put it all to work very quickly, then we're going to have cash drag. That's going to water down the returns, and that's going to cannibalize the fund. So that's absolutely something we will not do. If we don't believe we can efficiently put that capital to work, very quickly and efficiently, we're not going to take it. And we've had months in the past where we would just we closed it to new investment very early in the month. Right. So we said, okay, we're kind of at capacity this month, and we were getting subscriptions coming in the email and fax, and we called the investor and just said, okay, thank you very much, but we're going to put you in, schedule you in the queue for next month. Right,
because you've also got to reinvest all of the. I presume a lot of your investors are just letting it ride and not taking the income out, and they're just, you've got to then reinvest all the payments that come back in.
Exactly, and we offer three options immediately when a new investor comes into the fund. They can reinvest and compound their principal and interest. They can take out their interest income monthly. We're one of the few funds in the country that offer monthly income, and they can also take out their pro rata share of principal and interest monthly. And the fund cash flow is about 3% per month, give or take 10 or 20 basis points. And so that cash flow, that 3% cash flow per month, an investor can take out that cash every month with a slightly declining balance each month. And they can change their mind any time with the 1 month notice. So, but you're accurate that most of the investors are choosing to reinvest and compound, but we do have a portion that like the income every month, and that's fine too. Whatever the investor wants is fine with us.
Sure. So, do you mind sharing how large your fund is today, and what kind of returns your investors are seeing?
Yeah, we're approaching 30 mil now in the fund, and overall with Novus and Prime Meridian combined, we're at about 150 mil.
Okay.
When we started intentionally very small and slow and steady. We wanted to master the asset class and prove to ourselves and to the world that we can add alpha. And we've done that now. We know the asset class in this space very, very well. We know what we're doing now. And so now we're picking up steam a little bit, talking to more of the institutions, and so we believe that number is going to pick up substantially here in the next 12 months. So just under 30 right now. And what was the second question again?
So what and the returns you're giving to investors?
Yes, we've been averaging in the high nines for the past 2 years. Last year we did 9.89% net to investors. As you know, yields have been coming down, and so if you look at the industry in the last 3 quarters of 2013, the yields were marked down in each of those last 3 quarters of 2013. And so the new inventory that we were purchasing, and this is true for everyone in the space, had lower yields to it. So, going into 2014, and we're very transparent about this. We always have been. We always will be. Yields will definitely be lower for everybody in 2014 versus 2012 and 2013. And so we're expecting, somewhere in the eights, depending on, how things compound and things like that. But somewhere in the eights, maybe mid, high eights is a good, educated guess of where we'll end up this year. And,
right.
Yeah.
Okay. So, because Prosper, if you've been on Prosper, their average interest rate has dropped dramatically from, if you started in 2012, the average right back then was like 18, 19%. And now, now it's down to, 15% or even lower in some months. So I guess that's been part of the equation. The average rates are going down. So investors
it's definitely part of the equation. But the other counterpart of that is that risks are also falling as well. Defaults are falling. This is, in our quarterly report we just sent out recently to our investors, we made that very clear that the yields have been drifting, but not because defaults are rising. That's very important to point out, is defaults are actually falling, risks are falling, and so the yields have been drifting down to kind of compensate for that. But there seems to be, and I'm not sure if you noticed, but there seems to be equilibrium in the past few months. Yields seem to be very steady now, and it seems like we may have found at least close to a floor in where the yields are, at least for the near future.
Yeah, I agree with that. So let's talk a little bit about the industry and particularly about Prosper, since that's been your focus. You've seen you've had quite a wild ride if you've been on here for the last couple of years, and so the growth over the last 12 months has been nothing short of staggering at Prosper. How do you feel about that? Are you comfortable with their growth rate? Would you like to see it slow down or speed up, or where do you stand?
We're very comfortable with their growth rate. We think they're handling the growth very well. We don't want any company to grow too fast, more than they can handle. But we think, both, Prosper and Lending Club are having very significant but manageable growth, and I think Prosper's been doing a great job managing the influx of new inventory and new lenders that are coming onto the platform. Okay.
So then, as the growth is happening, are you finding when you're out there talking with investors that you don't have to explain this as much as you used to? That back, I'm sure when you started, you would have had to just start from scratch with a lot of people. But are you finding that today, the people just coming to you cold, they have a bit more understanding than they did 2 years ago?
Definitely. We noticed there was a big uptick in understanding really around April, May last year, and I think part of it was if you remember in the second quarter of last year, bonds took a big hit. So people were taking 10% corrections in their bond portfolios, and during that time, I think a lot of investors and investment advisors were researching the market on where's a safe place we can find yield. And peer-to-peer lending kept turning up on the radar. And that's when we first noticed in the second quarter, a lot of the people we were talking to were interested. They already had some knowledge. They were doing their homework and research. And it certainly helps. We want, investors and the people we're talking to be very educated and informed. But if they're not, we'll take them through step by step, and we'll point them to websites like yours at Lend Academy and Prosper Lending Club. Yeah, our own website. There's a lot of resources out there that we can point them to.
Sure, and just that second quarter last year also coincided with the big announcement with Lending Club they had an investment from Google, which I know from my personal experience that was one of the biggest traffic days that I've ever had, and the day that was announced, and not only that, it seems like I hit a new level. I never went. It's just the number of people that started to follow the space as a result of that deal. I think that was, to me, I really noticed it, that suddenly there was just more interest. And then later in the summer, the Wall Street Journal and the New York Times ran front page stories on the same day about this industry. So that helps as well. So yeah.
Yep.
So then let's switch gears a little bit. Like, what would you, when you're looking at Lending Club and Prosper today, and I know you're just getting started on Lending Club, but I know you've obviously been following them for a long time. Where do you think they need to improve, or what changes would you like to see happen?
Well, I would like to have unlimited access on both platforms.
Right.
But
wouldn't we all? Yes.
One thing I always think that I do when I'm dealing with partners and vendors is put myself in their shoes, and if I'm in their shoes and working on their side of the table, would I do things differently? And when I look at it that way from their shoes, I really think they're doing a lot of things right. We can't really knock what they're doing. We all want more access, right? We want unlimited access, but obviously they can't do that, and they can't do that with everyone. Because demand's very high and there's only so much access to go around. So if I can just pick one thing though, here being on the spot, just one thing that would be good with any company, is just try to be as proactive as possible. And I've communicated this. That would be the only thing. And I think when you're growing very fast, sometimes you're in this reactive environment, and
Right.
and sometimes you have no choice. Even if you have the best management team on earth, you're growing very fast. There's a lot of things going on. There's a lot of changes being made, and so you're constantly in this reactive environment. And so, in a perfect utopian world, being more proactive versus reactive with things like, let's just say, constraints. Like, for example, on the fractional platform, when they moved it down to 10%,
Right.
Cap on fractional loans. In a perfect world, if they would have gave us all 60-day or 90-day notice on that, that would have been wonderful. But that's not that big of a deal. It's they had a decision to make. They had to make sure it was a fair playing field for everybody, and we rolled with it. It was fine.
Right. So yeah, you're on the other side of that. I mean, most of the Lend Academy readers rejoiced when that was made, because it suddenly meant we had a little bit more access to the loans we wanted. But yeah, you're on the other side saying, well, that was a real drag for you as far as putting your money to work, I imagine.
Right, and we were a big participant, and we're doing whole loans as well, but we were also a big participant in the fractional pool. And but again, we after thinking about it, and it makes sense. You have to have a fair playing field. You have to have a healthy retail base, and so we understood all. I mean, a lot of the decisions they make total business sense to my mind, and I would do the same thing if I were in their shoes.
Sure. Yep. So, before I let you go, I want to ask you a couple more questions. One is, like, we're recording this on April 17th, and this is the day, the big news that came out that Lending Club has made their first acquisition in the space. I wrote an article about it on Lend Academy this morning. Wanted to get your take. What do you think of this acquisition?
I think it's smart. I think it's a natural step in their progression towards an IPO. And, it makes sense to me. And we've been anticipating a $4 billion plus valuation with the Lending Club IPO this year. And this kind of puts it right up against that number. So it all makes logical sense to us.
Right.
And if they're going to, if Lending Club and Prosper are going to continue to grow, they have to pick up new areas of growth, and that's going to include acquisitions naturally. Yep,
sure. Well, I think if Lending Club would do an IPO and right now, then you'd probably be spot on. But if with your $4 billion number, but if they wait till October or November, the way their valuation seems to be going, it's going to keep going.
Maybe $5 billion plus.
Yep, for sure.
No, I agree. It's and then of course they as most companies when they're planning an IPO, they want to time the market as well. You don't want to IPO if the market's in a 10% correction.
Yep.
So I'm sure they're looking at those types of things as well.
Right. Well, yeah, and that's the thing. They've always said they want to be. They've never said they're going to do an IPO this year. They've always said they're going to be ready to do an IPO this year, and so
right.
that leaves their options open if things don't work out, and it's not a good time to pull the trigger.
Yep.
So, last question: What are your plans for the future of Prime Meridian? Are you going to launch new funds? Where are you going to go with this? Do you think?
Yeah, that's a very good question, and something we put a lot of thought into. And we're exploring, the idea of doing a more passive fund versus the current fund, which is a little more active. And how we define active for those out there who don't, it doesn't mean we're actively trading it, but it means we're actively filtering and choosing, what we believe are the best risk-adjusted loans. Whereas a passive approach is we just kind of buy anything and everything on the platform.
Right.
So we've looked at the idea of launching a passive fund in the future. Obviously, we have to be approved for a launch of the passive fund by Prosper or Lending Club, and we have to make sure we have the access. We don't want to launch it and not have enough access. So for the time being, we're putting all of our attention into the existing fund. One thing we can be very certain of, though, Peter, and this is very important, we put a lot of thought into this, is that no matter what we do, no matter what platforms we work on, whether it's Prosper, Lending Club, Funding Circle, whether it's a debt consolidation loan or whether it's a business loan, there'll be one common powerful theme, and that it's all going to be high-quality, short-duration prime debt. We're not going to do any subprime debt at all. We're not going to go farther out on the risk spectrum. So many people right now in this country and around the world are chasing yield. And history is riddled with examples of painful lessons and tearful lessons of people that go too far out on the risk spectrum chasing yield. And everybody wants that extra point or two, and they're going they're doing subprime, they're doing very low quality. There's business loans out there that that are taquerias and janitors and dry cleaners, and there's subprime individuals that own those businesses. We're not going to do that type of debt.
Right.
That's one thing we're very clear on. We're going to do high quality, prime debt. And so any business loans we do, it's going to be very high quality business loans, fully collateralized by real businesses with solid assets and debt coverage ratios, backed by a creditworthy prime borrower with personal guarantee. And so that's the common theme of everything we do.
Right.
High quality prime debt.
That is a good point because, we don't have to go back too far to remember what kind of a debacle that can happen in when people get too aggressive with this stuff. So, and we don't know what the future holds, whether we're going to have another financial crisis. And if I'm sure this is your thinking too. I mean, if we have another financial crisis, the people that hold the prime debt are the ones that are going to hold that. They're going to do the best, while others will have negative returns most likely.
Right. Well said.
Okay. Well, on that note, I really appreciate your time, Don. Thanks for sharing your thoughts with us. And I'll catch you at Lend It.
Okay. Thank you very much. Looking forward to it.
Okay. Thanks, Don. Bye.
Take care.
I'm glad Don brought up that last point because I think it's something that is not talked about enough in this industry. A lot of us, myself included, are trying to strive for double-digit returns, and we invest in the highest risk loans. And if we get another major economic downturn, or heaven forbid, we get something that was worse than what we experienced in 2008 and 2009, we are going to be hit the hardest, the people that are investing in the highest risk loans. Something to keep in mind. I don't think that we should expect these 10% returns year in, year out. That just seems unrealistic to me. So on that note, I will sign off. We are all done with LAP13 episode on the podcast, and we'll catch you next time. Thanks.